Hey everybody, it's Steve at Credit Suite. Welcome to our StreamYard today. We are so happy you were here. Matter of fact, we are 1 week from Thanksgiving, and we are thankful you're here to listen to us today. We got some exciting stuff to talk about today. Let me pull up my screen so we can talk about how to ensure your business financials promote maximum fundability. Don't forget, get your business credit with your EIN. Go to creditsuite.com/EIN. I am not Ty Crandall. Ty is actually doing the amazing Get 30 Business Funding Options Challenge today. Today's day 4 of 5. Go to funding30challenge.com. Go ahead and get in there. By the way, you have an opportunity to buy the recordings if you'd like. It's 5 days of amazing material. Don't miss out. Don't forget, by the way, like this video. All right, so let's dive in. Business financials and fundability. It probably comes as no surprise that your business financials affect the fundability of your business, right? So we talk about fundability. There's over 125 factors. We have a fundability wheel that we show people, and part of that wheel is your business financials. But what are lenders looking for, right? What are they actually looking for when they look at your financials? Is it just income? Is it just expense? Do they want tax returns and financial statements, right? So what we're going to do today is we're going to break that down a little bit, all right? By the way, call for your free business credit consultation, 877-600-2487. Again, 877-600-2487. Me or one of my team will be happy to go through your fundability factors with you, talk about what you have to do to straighten them out, and get you moving forward. All right. So what is fundability? It may help to remember exactly what it is. All right, fundability is the ability of a business to actually get funding, and it encompasses a number of things. In fact, like I mentioned, Credit Suite recognizes over 125 factors that affect fundability. All right, one thing we do is help customers assess and increase the fundability of their business. It's a huge web, a monster web that is virtually impossible to navigate on your own. Having a business credit specialist can be unbelievably valuable. Look, I've done this on my own and I've done it with Credit Suite, and it's a game changer. We're talking 2, 3, 4, 5 years versus a few months, a few short months. It really is a game changer. Don't forget, grab your free business credit building guide at creditsuite.com/live. All right, so what affects your fundability? While we do recognize the 125 factors that affect fundability, these factors are divided into more general principles or different, I don't want to call them tiers, but sections of our fundability wheel, right? One of which is the business financials. Let's break down each factor within this particular principle, right? First is going to be your business tax returns. This is huge, right? This is a big one. For maximum fundability, lenders like to see at least 3 years of business tax returns. I know that's difficult when you're only in business 2 years or even 1 year, but they're looking to really see 3 years, looking for some stability. Some traditional lenders will not even consider an application if the borrower doesn't have at least 3 years tax returns to show. Okay. Sometimes these are the only financials they need to see, though. The longer your tax history, the better. And of course, all tax returns need to be up to date, right? And it goes without saying, all your taxes need to be paid. If you aren't paying your taxes, lenders will not believe you will pay a loan, right? Goes without saying. No different than if you went to apply for a mortgage personally and you owe the IRS money, they're going to want to see either you have a payment plan or that is paid off. All right. So lenders will also want to see that you are what they call solvent. They want to know that you can meet your obligations. Sometimes tax returns are enough, right? But your fundability will be stronger if you can provide financial statements as well. Now, what are financial statements? This will include a statement of all income and expense and a balance sheet, all right, which shows total assets and total liabilities. All right. It's also a statement of cash flow, right? What your business looks like on a monthly basis. With these reports, lenders can help make a number of calculations that will help make them decision. Well, will help them make a decision. Excuse me. Traditional banks typically have a credit analyst that does this. For new credit decisions, a credit analyst will compare financial statements for at least the past 3 years. They can even get more financial history that's even better. So in other words, if you can give them more information, it's just going to make their job easier. They're going to look for trends and patterns. And by the way, I forgot to say, my crack team social media experts are sitting there in the chat box. Go ahead if you got a question, put your question in there. They'll do their best to answer. If not, you can always reach out to us at 877-600-2487. And don't forget the funding challenge. All right. So they're going to look for trends and patterns in your business. In other words, when they're looking at your financial statements, they're looking to see is what does your business look like, and can they guess what it's going to look like going forward, right? So having a business plan is nice, but if they can see financials that are projecting based on your sales increasing at, let's say, X% over the last 3 years, they can project what your sales next year and the following year and the following year to that are potentially going to look like, and obviously profit and loss in those particular periods. They will also ask for explanations for anything that looks kind of off. For example, if there's a sudden increase in debt or expenses or a decrease in the bottom line, they'll question it. Hey, tell me what happened here. All right. It could be as simple as you just bought equipment and depreciated it and made it, to lower your tax bill, but you actually have the asset. See, that's part of the balance sheet as well. All right. By the way, audited financial statements versus company prepared financial statements are a big difference. For this reason, audited financial statements provide an even stronger fundability factor. Audited statements will already have notes explaining any major fluctuation, and they are much more reliable. It makes it easier on the credit analyst to make a recommendation for the underwriters to get their jobs done as well. Okay. So if you have financial statements and you're thinking about auditing them and you're thinking about going for a loan, this is well worth the investment. And by the way, I believe it's a tax write-off as well. It does cost money to have them audited, right? But there you go. The fee is tax deductible, and you can save money by making sure you're organized and prepared. I actually had my financial statements audited when I had my manufacturing company, so I knew it was tax deductible. That's how I knew before I even got to the slide. You can save money by making sure you are organized and prepared. Auditors typically bill by the hour, so the easier you make it on them, obviously the less it's going to cost you. If you're super organized using QuickBooks or some other system like that, where you're entering your data on a daily or at least weekly basis, it's a lot easier for them to audit it. Okay, so professional versus company financials. There is another option. If you do not have audited financial statements, professionally prepared statements are going to promote stronger fundability than if you simply just turn over your company prepared statements. Okay. In other words, professional will be a CPA. So if you had a CPA prepare your statements, not technically audit it, just prepare it versus what you just hand them. All right. If you know you have some major fluctuations in your financials, you want to be prepared for this. You want to anticipate the questions that are going to be coming. For example, maybe you know expenses increase dramatically from year 1 to year 2. Make sure you know why that happened, obviously, and then that way you can answer the question when asked. It only helps you, by the way. Often it's sometimes as simple as an increase in utility rates, or you're hired a new employee, or like we talked about, maybe purchase new equipment, or maybe brought in inventory in the print manufacturing. I would, at the end of the year, a lot of times buy a ton of paper to keep in storage, knowing I would use it for repeat customers throughout the following year. I'd get a huge discount. I'd get that right off at the end of the year, so I'd have a heavy expense between December 15th and December 30th. So you need to anticipate the questions. On the flip side, you need to know if there is a sudden decrease in income as well, and if so, be able to explain that as well. It's not always something bad, right? Like I said, I mentioned buying that inventory, but credit providers still need to know and understand how to make an informed, or not how, to make an informed lending decision. All right, and being able to answer their questions let you know. Well, you let them know that you know and understand your actual financials, right? So if you look at your financials and you see something that looks out of whack, a little out of whack, dig into it, figure out what it was. It may have happened 6 months ago, and you'd be like, oh yeah, that's right, I remember I did X. If you have that prepared, it's just going to make it easier for you to get your loan approved. It makes your fundability look much better. All right. So what else do they consider? In addition to comparing raw numbers from year to year, lenders also look at the number of ratios to help determine creditworthiness. Now, some of them have their own formula for various numbers they look at, but there are some general standard ratios that are commonly used. All right. So some common business financial ratios are a few easy to calculate ratios can give a lender a lot of information. For example, the current ratio can help you understand whether a business will be able to meet its obligations, even if the unexpected happens. It is calculated as total assets divided by total liabilities. All right. It's called the current ratio. Total assets divided by total liabilities. You've got $1 million in assets, you've got $500,000 in liabilities. The assets divided by liabilities equals 2. Your current ratio would be 2. Okay. Consider this example. There you go. I just gave you one. If your business has 20,000 assets and those 10,000s, current ratio is 2 to 1. Right? Assets are double the amount of debt, basically. All right. That looks fantastic to a lender, by the way. Double the amount, fantastic to a lender. Another useful is what they call a quick ratio. This is similar to the current ratio, except it reduces total assets by total inventory. That's because you cannot turn inventory into cash immediately, like my paper example, right? That doesn't turn into cash immediately, all right? You cannot really be used, common business financial ratios. It cannot really be used to pay obligations in the short term. If something happens to you and you need all the cash you can get from your assets immediately, inventory is not really going to be a part of that because typically you're going to discount that to get rid of it quickly, right? A healthy number for this ratio is 1 or more. All right, you obviously don't want to be negative on this particular ratio. One more ratio that's often used is the debt to worth ratio, right? You've all heard of debt to income ratio. This is debt to worth ratio. It's calculated as total liabilities divided by your net worth, right? Net worth is simply total assets minus total liabilities, right? So that would be your actual net worth. The ratio tells you, the lender, and lenders, how much you owe versus how much you own. In other words, how much of the business is really yours, free and clear of debt. You've all seen this. People file bankruptcy, they say total liabilities 1 million, total assets 700,000. You're basically bankrupt, right? So you've got $700,000 if you have no income. You have $700,000 in assets. You have $1 million in liabilities. You can't sell off the assets to pay down the liabilities. That you'd be upside down. Okay. There is some overlap in fundability, by the way, when it comes to personal and business financials. So we're going to kind of dive into that a little bit. Traditional lenders will typically look at personal financials separately from the business because they will usually require a personal guarantee, by the way. But they will still take note of how you get money from the business as part of the business financials as well. Do you pay yourself a salary, right? Do you just take funds as needed? Do you give yourself quarterly dividends? K1 distributions, we call them with the S Corporation. All right. Remember, there are over 125 recognized factors. This is just one that we're talking about today, and it's actually a subset of one. So this is just one subset of one fundability factor, and there are over 125 of them. Business financials and all that go along with them are just a very small fraction. In fact, if you don't count the overlap, this is 6 out of 125. I actually count it as one subset, or 4.8%. If you count both business financial and personal financial factors, as well as other financial information that affects fundability, such as information from personal credit history, data agencies, credit bureaus, you still end up at about 27%. So there's a lot going on when it comes to fundability. It's important to remember that all the factors are not weighed equally as well. Still, it's easy to see there's much more to fundability than just what you see on the financial statements or tax returns, right? There's a lot there. Having bad financials will get you not denied by a traditional lender almost certainly. Matter of fact, 100% of the time it will. But having good financials doesn't necessarily guarantee you approval either, right? You need strong overall fundability. This is the thing we just beat up on and talk about on a regular basis. I know I went through this quick because this is not a super exciting topic, but it's important for you to realize that when we talk about fundability, I know everybody likes to talk about business phone number, address, all the things that we tout all the time online, but there's so much more to it. This is what some people fail to realize, and then they still go out and get turned down for loans. And they're like, wait a minute, I have my DUNS number and I have all the things that you told me to get. Well, that's typically 5 to 7 items that we talk about. Here's 6 more. That's 13. There's 125, right? So if you're not sure about that, go to creditsuite.com/EIN, download your free guide, right? Or go to creditsuite.com/live and get your free business credit building guide, right? And certainly you can call us at any time. This is a recap. 125 factors that affect fundability. These break down into more general categories. Business financials is one of them. By knowing what lenders are looking for, you can better know where you stand in regards to getting to business financials and fundability. If you want more information, look down below, check out the description, all right? Don't forget, our challenge, get 30 business funding options in 5 days. We're on day 4 today, the funding30challenge.com. Go there and register. Look, get the backstage pass. Go in and meet some of the lenders. Get the recording of all 5 days. You go back and review it. I'm going to tell you, as employees at Credit Suite, we all keep jumping in just because we love what we're hearing. It's a big deal. Funding30challenge.com. Don't miss it, okay? Don't forget, you can call us at 877-600-2487. Have us check out your fundability, see what it looks like, right? See if there's anything you can do right now. The next time, we're going to talk about your business structure. Do you need to incorporate? Is the sole proprietorship a real viable option? What about an LLC? All right. We'll see you next time. Thanks so much for joining us today. This was how to ensure your business financials promote maximum fundability. Don't forget, go down below, give us a little like. If I don't see you before then, enjoy your bird next week.